We are now going to take a look at technical indicators. Just go over an introduction though at this point, overall concepts and theories of them, what they are, what they show you, why you should consider using them. Just go over all that sort of stuff, and then we'll get into specific technical indicators with more of some practical examples in the subsequent videos. The one thing that I want to start off and drive home is that we need to remember the two king technical indicators are price action and volume of shares. All other technical indicators are mathematical formulas that are derived from these king indicator data points. In other words, indicators, they're just mathematical formulas. Now don't worry, we're not going to sit here and this isn't going to turn into math class and I'm going to be breaking down everything. Nothing like that. But you just have to understand that all these mathematical formulas, what they're calculating things from are price action or volume of shares. So it's one of those, it's one of those concepts or themes of charts that lead a lot of people astray. They think that there's some sort of like holy grail formula out there where if you use this indicator with that indicator, that it's some sort. There is no holy grail. You have to remember the king indicators, the best indicators to use are just what is the price doing and what is the volume of shares doing. The other thing with indicators is that all price data is fair game. Some indicators are going to use closing price, others may use low prices, some may only use high or combinations, but it's all fair game. All the formulas are different, and I should note that I'm only going to cover still a good chunk of the technical indicators out there, but I mean there's all sorts of them, and there's always new ones popping up because people are coming up with new mathematical formulas. And so it's one of those things where it's always evolving, but it's kind of a trap in the sense where if you forget who is king, and remember the king is price action and volume, then you can kind of fall into that trap. But I am here to just reassure you that we need to use them as support, not the total driving force. And indicators are displayed in graphical form on a chart. And it's usually immediately below the candlestick portion. So here we have our candlesticks, here we have our volume, and then most charting software will have right down here, there will be some sort of, indicators or something like that down in that section of the chart. And that just makes it easier because, for comparison's sake, you can, all right, so what's happening at this point in the price? Okay, you have that going on with the volume, and then you have, that going on with an indicator. So it just makes comparison a little bit more efficient and just saves you some time. So Clay, you just sat here, told us how they're all just mathematical formulas. They're just representations of price action. You didn't really seem too excited about them. So why should we even use them? Well, I like indicators, and I'm not saying they shouldn't be used. I just want to give warning. Don't fall into the holy grail trap. And I speak from experience. When I first got started, I spent so much time mismatching or just matching or trying to match indicators up, and it just, nothing worked 100% of the time. Thanks a lot, genius. I finally figured that out. There's just no holy grail. But why should we use them? Why should you use them? Because they are still helpful. They are helpful because they give you a different perspective. If you want different perspectives, that's what indicators can allow you to do. While the mathematical formulas, while their complexity does differ, it's up to you to figure out what works for you. So what do I mean? Well, there are a multitude, like I said, of indicators, and new ones always coming up. But at the end of the day, they serve two core purposes. There's two kind of why use. Well, because of these two areas. One, they can act as a heads-up type alert, and the second can be a confirmer tool. They can help you confirm other bits of action within the chart. So charting, and I've been reiterating this, is all about personal preference, and there is no better example than this compared to technical indicators. You are going to need to find which and what combinations serve you best for heads up and confirmers when you do your analyzing. So no, I'm not going to sit here and tell you this is how you have to do it. You have to use this indicator, and that indicator, and then you have to look for that, this, and the other. That's not how it works. We're all different. You may find a combination that you feel more comfortable with. I am here to teach you about indicators and how indicators function, but it is going to be up to you. So I'm This is almost like cooking school. Here's a tomato. A tomato is this, that, and the other. Here is an onion. It's this, that, and the other. Here is a piece of beef. It is this, that, and the other. But you have to figure out, okay, I understand now what a tomato, what an onion, what a piece of beef is, its attributes, how it functions, but how am I going to combine these? Should I combine those? That's going to be up to you. So I'm here to educate you on indicators and some of the indicators, but I'm not going to tell you, hey, you have to use it like this, that, and the other. You need to figure out what you feel most comfortable with, and that way you can trade with the utmost confidence. Now, the biggest thing with indicators is they're just an assistance tool. They can help you build and then monitor watch lists as you have, groups of charts that you're watching. They're a great tool for that. As a heads up alert, they're a heads up kind of, well, what are they giving me a warning to? What are they saying? Hey, caution. Heads up to what? Well, slowing momentum and strength, and this could be a signal to watch for a possible support level break. So indicators could be saying, hey, I think the fortress of Wanter the Bull is starting to run out of, I think those walls are starting to crumble. They can be a great helping assistance in that area. Divergences, is gas running low? So if a car is just speeding along, if the price is just momentum, strength, indicators through divergences, which we'll talk about, can kind of be like, well, it looks like gas is starting to run low. Or again, with that fortress example, okay, I just saw a piece of stone fall out of the wall. Okay, there's another piece of stone. I think the wall is getting a little shaky. Now, has it means the wall is going to crumble or has crumbled? No, it's just giving you a little heads up like this may be looking, so it's just giving you a little bit of foresight. Acting as a confirmer tool, which is definitely secondary. Secondary to what? What are the king indicators? Price action and volume of shares. But as a confirmer tool can act as a gauge of strength to assist in confirming the strength or lack thereof of a break in support or resistance. So in other words, if price breaks resistance and then indicators are all acting bullish, you can have more confidence in that break. So as far as gauges of strength, very good job in saying, hey, yeah, this move looks strong, or yeah, the move happened, but I don't know. It's not as strong of a break as what you'd ideally like to see. So good little secondary confirmer tool. There's two kind of core types of indicators. One is leading, the other is lagging. So let's talk about leading indicators. And I really, I'm not going to not tell you about it, but just so many times people hear leading indicators and they think, oh, okay, good, now I can tell the future. It doesn't work like that. If it was that easy, you know how that goes. Every single person will use them, and then they just wouldn't work anymore if every person is using them. But leading indicators, these are formulated to lead price movements. They represent a form of price momentum over a fixed past period. So keep that in mind, past period. My favorite leading indicator is volume, one of the king indicators. Surprise, surprise. Why volume? Well, let's think about this. Again, I think I used this way back in the technical analysis. We believe it's all in the chart, all in the price action volume. So if, a chart has, this volume, this volume, this volume, this volume, and then all of a sudden, there's an earnings call or something like that, and then all of a sudden, right before the earnings call, has a big volume bar like that. Could that be a leading indicator that maybe people know that the earnings call is going to be a good one and people think that the price is going to go up? Yeah, I think that's a pretty good, rational, logical conclusion. Now, is it a guarantee? It is not a guarantee. That, the pros and cons, that is a pro. It could be a nice leading indicator. It could be an early warning signal of possible bullish action before it happens. But no guarantees. There are whipsaws, which mean whipsaw is essentially just a false signal. Who knows? Maybe these people are wrong. Maybe this is just an anomaly. It doesn't mean anything at all. That's always a possibility too. But as far as giving us some sort of, rational, logical, hey, look at that. That looks interesting. Especially if, maybe the price has been coming down, but then that the earnings call is coming, and then this big volume bar happens, and let's say a hammer candle forms right around an area of support. Interesting. Maybe all those three things functioning together, but the main, driving force being volume. Maybe that's a leading indicator that, that the earnings call is going to be pretty favorable. And I want to point out this real quick because I see it all the time and it drives me nuts. If anybody is advertising, they have the secret. They have the secret way to do something. They have the secret formula. They have the secret. No, it doesn't work like that. First, why would they be giving it away? Usually, and it's a pretty dirt cheap price. So why would they be giving this rocket science secret away for a dirt cheap price? But second, there just isn't any secret formula. There isn't any leading indicator. Yeah, sure. In this situation here, it could work out very nicely, but it's not going to work out very nicely every time, and I'm going to be straight up and tell you that. It's not going to work out every time. If there was a secret formula out there, you wouldn't know about it because people would keep it secret. So just know, don't fall for any of that, and don't try to go on that quest for the Holy Grail. It's not out there. Take this stuff for what it is. What this stuff is help you to make logical and rational decisions. And kind of just to sum things up, never put your rent money on the line just because of a leading indicator. If you see a couple things going on and you're like, oh, it's a leading indicator, I'm okay. Little Billy Bob, I'm going to take your college tuition money, and I'm going to take your college tuition money, and you are going to have to, not going to be able to go to school because I'm putting it all on this leading indicator. Well, then Billy Bob's going to end up becoming a penny stock CEO someday of, who knows what, of probably like an Apple company or something like that. Not Apple the company, just like an apple tree company, So don't force Billy Bob to go down into penny stocks and become CEO of an apple tree company because you put all his college tuition money on the line because you just saw some leading technical indicator, and you thought, hey, it's going to be great, and then it's a whipsaw fall signal, and then you lose all of Billy Bob's tuition. It doesn't work like that. So be conscious and be aware that leading indicators don't warrant going all in. And I know I'm rehashing and beating a dead horse here, but I really want to drive it in. I see it all the time. People are misled thinking leading indicators are some sort of holy grail. It just does not work like that. The other type are lagging indicators, and these are trend following indicators that follow the price action. Now, very crucial thing here, you need to use only when the trend is your friend. If a stock is trading sideways, avoid lagging indicators at all costs because you are going to get slaughtered by the whipsaws. So keep that in mind. We want situations like this where there's a clear trend, where there is a clear leader, and then a bunch of people are following the leader. That's what we want. We don't want price action like this. That is not trending. That is just sideways, and that's going to create whipsaws, and it's going to slaughter people. And you will see that with the moving averages and what I like to call spaghetti. But I don't want to get ahead of myself. The pros and cons. One big pro, when things are trending, they give you the ability to stay strong and be confident. So I've already talked about Braveheart, my other favorite comedy right here, Dumb and Dumber. So another movie assignment, go watch Dumb and Dumber if you've never seen it. And whenever you see this sign now, I guarantee you will always think of lagging indicators. But be strong is what lagging indicators help you do. Of course, again, I need to keep reiterating and annoying you with this, but be strong when. You should be using only when a stock is trending and has the trend in your, not necessarily in your favor. They just need to be used when a stock is trending. Signals tend to be late. That's just a reminder. It is a lagging indicator. So it's coming from stuff that has already happened. And the other con would be, as we've reiterated, they're not useful. So do not use in sideways movements. So, famous one is moving averages, but moving averages have no use in sideways movements. Just get that across right now. There is no use for these if the stock is not trending. Let's talk about some umbrellas real quick. There are three umbrellas, as I like to call it, of indicators. You have the momentum indicator umbrella, the trend indicators umbrella, and the volume indicators umbrella. All these are, are kind of the overarching umbrella of types of indicators. So with momentum indicators, the momentum umbrella, You have the relative strength index, RSI, stochastics, the tricks, the rune, and there are other ones. I'm just listing some. We will talk about some of these in the course. Trend indicators, you have moving averages, the moving average convergence divergence, the MACD, Wilder's DMX or DMI, volume indicators, chalk and money flow, on balance volume, money flow index. So there's many more that I'm leaving out. I'm just letting, or the point of this slide is just to let you know that there are within the family of indicators. That family then gets broken down into what I picture as umbrellas, and then underneath each of these umbrellas, you're going to have different type of indicators. And in our final slide here, I want to annoy you first and then cover another very, very important concept. But best indicators available, yeah, you know it by now, price action and share volume. Do not let indicators fry your robot circuits. Indicators are just, as I've said, distorted representations of the king indicators via sometimes very, very complex mathematical formulas. So don't overwhelm yourself. Don't have a chart with 8 million indicators on it if your mind can't handle it. Like I talked about in the support and resistance case study video, don't throw up 800 supports and then another 1,200 resistances and have lines all over the chart if that's going to confuse yourself. Don't fry your circuits. You know where your circuits are most comfortable, so keep that in mind, and that goes with indicators too. And this one is so crucial. Do not lie to yourself. Indicators make it, if you don't know what you're doing, but from this point forward you are going to know what you're doing, they make it very easy to lie and mislead yourself. So how do we avoid lying to ourselves, or how can they lie to yourself? Well, remember, we just talked about the umbrellas. And if you're using indicators all from one umbrella, so actually let's do this. So let's say you decide, you know what, on my chart, I'm going to just throw up all these indicators right here. So yeah, on your chart you have 1, 2, 3, 4. So you're like, yeah, that's good. I have 4 indicators. That's not too many. That's not too little. I feel comfortable. Okay, fair statement. However, your 4 indicators are all from the same exact family of indicators, of momentum indicators. So are you really giving yourself a clear picture of everything that's going on? Well, of course not, because you have totally left out trend indicators and volume indicators. Now, sure, you still have price action and volume itself. However, from an indicator perspective, such as this, you're tricking yourself. You're basically, all these are going to be telling you the same thing at the end of the day. They're all momentum indicators. So, but you're not getting any sort of other information. You're telling yourself, yep, I got 4 indicators, that's perfect. However, they're all from the same exact umbrella family. And that's not going to give yourself a true representation, and that's what's going to mislead yourself. So a great way to avoid this is just choosing one indicator from each of the umbrella families, and then that should be more than enough. I would say 2 at most. Anything more and you are going to experience paralysis by analysis, and I speak definitely from personal experience there. So again, I would say 2 at most from each family. If you start going above that, paralysis by analysis, I would say the odds of that happening to you are pretty darn high, especially where you are right now, newer to things. You don't want to sit there and freeze up because you're analyzing so much. You have all these indicators going on. So, 1 or 2 from each family. So, you could grab, this is off the top of my head. So, the RSI over here, definitely moving averages, MACD, come down here, maybe, money flow index, so you could go 2 from one family, 1 from the other ones. There's all sorts of different combinations. But as long as you're not grabbing everything from the trend indicator, or grabbing everything from the volume indicator, or grabbing 1 from momentum and then everything else from trend, or 1 from volume and then everything else from momentum, you want to just give yourself, it's like a mutual fund. You want diversity. You don't want to put all your eggs in one basket, because all those eggs are going to tell you the same thing when one of these other umbrella family indicators may be saying, but hold up, warning sign, in another situation. So keep that in mind. You want diversity within the indicators themselves. And with that being said, that's going to wrap up this introduction here. I started with it. I annoyed you with it. Remember the king indicators. There's no such thing as a holy grail. There's no secrets out there. It's just a matter of using these as kind of like if you were a ground troop. These are kind of your air support, maybe your naval support. But you are going to be the one that needs to focus on those core indicators of price action and share volume, and then everything else is just there as secondary kind of help for you if you want it and if you need it. But let's move on. We're going to next talk about moving averages, my favorite of all the technical indicators.